Hello everyone, it's me, the Boss Hog, and today I have some really lovely updates. As you can see from the title, we're up 12%. I've only had green days in 2023, and we're on a 10-day winning streak. On top of that, my third largest position had half-yearly updates, so we'll be looking at those results. My second largest position had a trading update that was well received, and my largest position has been on a tear for the last 2 months. Let's do it. Okay, so off to our dashboard. Thank you very much for the feedback, everyone. This was pretty well received. I've made some updates since last week, so we're going to walk through them and I'll tell you what those updates are as and when we go. To start with, though, we've got our consolidated portfolio overview. The first update here is the week-on-week change. Now that I have some data historically, we're going to populate this as and when we can. I also think for week-on-week, it shows very clearly how the week was. So basically 5.5 grand was our profit last week. Now it's up to close to 11, so a really good week, obviously. Both Trading 212 and my Google document that we're using here went up 5.4. Trading 212 up fractionally more, so it closed the gap, and the delta between them is now about 0.3% of portfolio. Again, I'm happy with that kind of variance considering you've got FX, spreads, and everything else in terms of different data sources, so really good. It also shows as well that we had £72 of dividends, so we'll be touching on that very shortly to explain where that come from and what I did with it. I also had a bit of a rejig of the graphs here. So first of all, my overall portfolio value now has a figure on it. I didn't actually call this out last week and nobody asked me a question, but just in case there is any doubt at all about what this long line is, that's basically just the rest of the year. So I populated the background data so that it automatically updates as and when we go through the year. So that's why all of my graphs will be very similar basically from that perspective. In terms of the time-weighted performance, which as I've said before is my most important measure because it's ultimately how I'm doing compared to the wider market, a really good week. It kind of looks ridiculous actually for January to date in general, but a really good week. You can see there that all of the stock markets have had a pretty good week. All of them are up sort of between 4 and 5% for January to date, and a pretty good week as well. It's a very friendly stock market at the moment, to be fair, but still my performance within that meant that I really closed the gap quite a lot on the FTSE 350, which is the only measure that currently is running ahead of me. I also introduced here the green line for the All World. This is the MSCI All World specifically. The reason why I did that is I was kind of curious how it would look first of all. My initial expectations would be that it would be between the S&P 500 and the FTSE, but it's actually underperformed even the S&P, which I thought was kind of interesting. The other reason why I introduced the All World was to give me sort of a comparison across the whole world, but also because of a couple of funds from Fundsmith specifically uses it as a measure of their success. So I've heard it mentioned a couple of times that fund managers are using it as their comparison. So I thought I would introduce it as well for my comparison. So we'll basically have 4 lines moving forward. So that's all good. This graph here on the left is also new, and it's got quite neon colors that I felt were necessary to call out, just because it's hard to read otherwise. So in essence here, this graph has a very similar direction and pattern to the one above it, but the one above it shows my overall portfolio value, right? So it doesn't look at profit, what the portfolio value is derived from, whereas the purpose of this graph is to really show that. So there are 3 different areas here. So the light green is my capital, that's what I've added, right? It's my cash, I put it in there, etc. Then the growth here is this kind of neon blue. The reason why it's neon blue is because it turns negative across much of 2022, right? That's what this means here, that the blue is underneath the green line on top, which means that my overall portfolio is negative. And then there's this little bit here as well where sort of the pink line is above, but the blue line is still there. That basically means that my portfolio is profitable in this period, but only because of the dividends, right? If I was to take out the dividends, it would mean that I wouldn't be profitable. Since the last couple of months, really, I've started to turn a profit again. Again, back here I was running really far ahead, right? I'd only put in like 90k, and my portfolio value was like 110, so I was really very profitable in terms of percentage at that point. And again, this is where we had this kind of happy situation where we were up here. And then obviously very challenging 2022 for everybody. Myself, especially in the early days of 2022, with my exposure to a couple of Russian miners, got really beaten up. But since then, I feel like I've recovered really nicely. So for me, this is good. And what I'm hoping this is going to show us as I go through my sort of 2-decade-long plan journey, that, the dividend will start to go really wide, right? Because of the nature of compounding. And likewise, the growth also. So right now, obviously, I went in quite hard. A couple of years ago, I had like 50 grand in cash. We were keeping it as a fallback when my wife was on maternity leave in case there was a problem. And then since then, we basically averaged in, which is, again, the reason why we have this big jump at the beginning, and then it sort of normalizes a little bit over time. So that's this graph. So for me, this is quite a useful graph as well. And lastly, we had this graph last week, but again, it continues to look really positive now. The profit is really going some. I'm almost at an all-time high in terms of my US profit. Specifically, my UK profit here, the blue line still needs to recover from that crash, specifically from the Russian miners. But generally, the direction of travel is really positive. The one thing I would say is, like, I'm not convinced that this isn't just, a bear rally. I'm not convinced that, too many of the fundamentals have changed. Part of the reason for me thinking that is if you look at this graph, this is basically the third, maybe the fourth time that there's been a little surge after this, right? I've got one there, maybe one there, maybe even five, you could argue. So it is very plausible that, in a month's time, this will look a lot worse. But right now, it's hard not to enjoy a very friendly stock market and enjoy being very comfortably in the green again. The other reason, though, that I'm not convinced also that this isn't the end of the bear market. I'm definitely on the more optimistic end of the spectrum in terms of how I think the world economy is doing, how I think markets are doing, etc. I think a lot of the data that's been published recently has been supportive of that idea, that even though things aren't exactly rosy, that maybe the expectation this is going to be as bad as 2008 or the early 90s when there were real macroeconomic issues doesn't seem to be borne out so far with the data. So obviously it may well change in a couple of years as people come off fixed rate mortgages, as people eat through their savings, as sort of inflation, even bad weather, right? If we have a bad winter, that's going to cause havoc with inflation. So I think a lot of people at the moment are kind of enjoying this, but are quite skeptical about whether it's permanent or not. I also have no idea. I haven't got a crystal ball. So although I'm enjoying the moment, I'm not getting overly excited and assuming. And to be honest, having been through 2022 and been beaten up, I kind of would like a bit more red. I'm still in the kind of acquisition stage of my investments, and so I'm more than happy to buy shares at reduced rates and worry about green, in a decade or two's time. In terms of this change here, you can see a lot of these are positive. I'll work on some formatting, by the way, just to make this a little bit easier to read. The really big movement here is Genius, I'd call out. It had a really good week. It is a bit all over the place, so you can see sort of very big movements. There isn't a ton of reasons for this. It's just, I guess general sentiment. It's sort of a small tech stock. But, this kind of movement now comfortably moves it into the fourth place in my portfolio. Amcor considers to have really good week on weeks as well. So, I mean, the quarter on quarter change here is particularly significant. There was earnings within this period, but this now moves Amcor comfortably to the first of my holdings. Likewise as well, Gamma, we'll get to them in just a second, but they had a nice trading update. So they're now comfortably in second, I would say. And Games Workshop had a really interesting journey this week. The share price is kind of wild for a FTSE 250 company. They published results midweek that weren't initially well received before the market sort of digested them, and the week actually finished ahead of where it started. So very crazy. Like if you bought that dip after the earnings, you did really well this week. So I'd call out those in terms of significant moves. Next up then, if I just work down, so we had a dividend from a Medical Properties Trust. So this was the £72 that we touched on earlier. I just reinvested it. I still continue to believe that the bearish arguments for medical property are overdone. I'm very happy to pick up the better part of 7 shares here with my dividend reinvested, and I will continue to reinvest into MPW basically until the share price begins with a 2, so $20 plus. I did just want to mention about Redrow. It had a pretty solid week, month and quarter. Redrow is my house builder of choice in the UK. It's a sort of mid-sized one in the market. And it sort of specialises in sort of family, forever homes, suburbs. It's kind of moving away from London and kind of more into cities in the Midlands and up north. So I think it's more resilient than many of its peers. But it basically rose in sympathy when a couple of very large house builders published what was seen as at least respectable results. So yeah, it's kind of, I'm going to call it rising in sympathy with its peers / competitors. And yeah, I am still slightly red on Redrow, but not by a ton. And once you factor in my previously sold shares and dividends, I'm actually up. So yeah, I continue to remain optimistic about the long-term direction for house builders. Again, I don't think right now they're like the best business you've ever seen, but they're so cheap that even if earnings halved, they still wouldn't be expensive. So for me, I'm sort of fine with any reasonable downgrades. They're well capitalized, most of them, and they continue to pay dividends so far. So I feel very comfortable actually owning house builders at the moment. I also wanted to touch on Disney because it's not one of the big 10 that I've chosen to cover. And to be honest, I think other channels cover them very well. Joseph Carlson did a 45-minute video on them, so you may as well go and watch that. I don't think I can add any more value to what's already been said there. But basically, this is Peltz's funds, so Trian Fund Management. I would say eviscerated Disney. Really strong argument that Disney is missing opportunities, isn't being well managed, has all kinds of issues, and really needs support / an activist investor. Disney did rise this week, as you can see. I'm not entirely sure how much of that was because of Peltz and how much of it was because of the wider stock market. But I just think it's worth calling that out. Having watched Carlson's video and sort of skimmed the report, I was quite convinced by the report, and actually that Disney's kind of missing a lot of opportunity there, to be honest. So although I remain still a long-term holder of Disney, just because I kind of believe in the brand and the ability to cross-sell, I do wonder if Disney's kind of gotten itself a bit caught up with the with streaming, and isn't really using its capital situation very well. Obviously, one day it would be lovely for Disney to start paying a dividend again and really growing. But right now, I'm, like many people, I suspect, a little bit in the red. I think I'm down about 15% on Disney, so it could be worse. Could also be better, of course. And yeah, so we'll see how that activist update pans out, but that's how it's looking at the moment. In terms of my sector breakdown, so I did also introduce a new graph over here, and basically the real split between these is this ETF slice, which doesn't exist in this graph over here. So the ETF slice is currently 11%, so if I total all my ETFs, that's what I get to. What I've then basically done in this graph is gone through my ETF and assigned them a category. Now that's quite crude, but as an example, if I look at HCAN, which is my Canadian exposure ETF, they are something like 40% financials. So I took the amount that I have in my Canada ETF and put it into the financial slice, right? I realize that's crude, but I'm not about to start dividing it into like 12 different segments and everything else. That's just overkill in my opinion, especially for a portfolio this size. Maybe if I had like millions, it would be a different story. But right now, I think that gives me an interesting breakdown. Obviously, the big change here is in terms of technology, and that's because I've got both Alliance Technology Trust and a Scottish Mortgage Investment Trust. Both of those are medium-sized holdings to me, and basically together give an additional 5%. So that's worth calling out there as well. So again, I just think that for me, like as ETFs continue to grow as a percentage of my overall thing, I think it's important here. Part of my long-term plan with ETFs as well is to kind of broaden areas that I don't have. So, consumer non-discretionary here, the utilities, oil and gas, I think as well could potentially be expanded further. Healthcare, likewise, is an area I want to grow. So I'm going to kind of use the ETFs to sort of improve these slices here, and they should get thicker over time is the plan with that. Then we've got my dividends. So again, just the MPW here means this yellow bar went up slightly and my cumulative went up slightly. So 51, 57 across my entire time. And likewise, that just then feeds into both my Q1 as well as my year to date. So £130 in dividends received across the year. So obviously first month. And I thought this was kind of interesting as well. So everything above this point are actuals, right? This is how it looks currently. I've then introduced this section as well, which is basically projections. So first of all, we'll start with the dividends graph. So the green here is my first attempt to do forward dividends. So this is mostly my own stuff with some data I downloaded, but I did have to fill in a lot of blanks, etc. For me, it'll be really interesting to see how accurate we get across the year. We'll see. I think actually, though, looking at the quarterly dividend projection is more interesting because for the first time, I've really got a pattern starting to emerge, right? If I compare Q1, the big difference here is Hollywood Bowl, which is kind of a recovery stock, is going to be a big dividend payer in February. So that's expected to be the big difference there. But still, Q1 is very quiet for me. I have virtually no UK payers compared to the middle of the year, particularly Q2, when a lot of my UK payers do their final dividends. So Q2 to me looks like it's going to continue to be extremely good. The pleasing thing for me specifically in Q2 is that last year that was boosted by a Aviva special dividend in particular, as well as a much smaller Fever Tree one. So it's pleasing to me that actually Q2 year on year is more or less flat, considering that that's sort of £550 across those two specials that won't be repeating, right? So that feels really good. But so you can see the trend here, right? Very quiet Q1, very busy Q2, then Q3 and Q4 sort of stabilize a little bit. And again, to me, this is kind of interesting that Q4 sort of expected to catch up materially with Q3. I think, again, that's a result of some stabilization. So last year, I started to have a little bit more UK shares. They went up to about 55% of total. This year, it's more like 50%. So although I do have some more presence in Q3 from my UK shares, a lot of stuff is going to be happening in Q4 that will kind of even that out a little bit. So we'll see how realistic this is, and we'll basically, these aren't going to be changing, right? So this is my snapshot in very early January for the rest of the year, and we'll be able to compare, this graph is going to get compared, I guess, by itself, actually, because the yellow is just going to populate in here, and we'll have a comparison. And then this graph is going to turn into this graph over time. So we'll see exactly what that looks like. So that's exciting. And then finally, my final change here is just a couple of long-term investment commitments, really. So first of all, I hope to retire when I'm 55, and I would class my retirement as very fat. I'm basically looking to retire with a figure of £5 million. Of that, effectively half is ISAs, because it's me and my wife. In terms of the remaining 250, it's split primarily between private pensions, and then there's also a fair chunk for my home, my rental income, as well as sort of general investments as well. So I can walk somebody through that in the future. But for now, basically, my ISA target is 2.5 million. And this is how I project I'm going to get there. Now, I did these projections at the very start of my journey, so November 2020, and they're based on me and my wife maxing out our ISAs for 20 years, as well as 8% annualized growth. So now, as a result of that, I would say September 24 here is going to be really tight. We'd have to really go some to hit. We'd require about 20% per year to that point. So that's definitely going to be ambitious, but that's also partly the result of the fact that last year, right, the S&P went down 20% and the FTSE 350 down a couple of percent. FTSE 100 rose a percent. So I think this target here is going to be slightly ambitious, but still, we'll see. What I would expect to happen is over time for this to more or less be realized. So again, we're assuming over 20 years that the market volatility will settle down, and we'll see an 8% year-on-year change, which will then give these. So it'll be interesting. Hit the first target there, 5th of November. Since then, we've only managed to add another 25 grand. So, but again, a difficult 22. So I'm still happy with it. And then over here, so I've basically got a bunch of dividends projections, and these are long-term dividend projections on the whole. So I'll probably start with the bottom figure, which is the most important one. And this is effectively how far along our income journey we are in terms of what our retirement will look like. Now, the current dividend to me isn't like the most important measure in our portfolio. It's overall portfolio value ultimately, right? Now, hopefully that will be derived mostly of profit and dividends, but also, of course, capital. That to me is really what these figures on the right represent, right? Overall portfolio value. But the thing is, the £50 target kind of extrapolates very nicely. So first of all, £50 per hour roughly translates as 100 grand a year, and 100 grand is the equivalent of 4% of 2.5 million. So effectively here, if we hit 2.5 million, I'll be able to create our portfolio so that we start seeing a 4% yield, right, in our retirement. So this is kind of one and the same figure. So realistically, I expect this figure to be quite slow to get up and running because the dividend income isn't the main focus of this portfolio. You can see that currently it's running at just 2.2%, so slightly above the S&P, but not by a ton. And again, that's really just because I wouldn't class myself as a dividend-focused investor. I do like dividends. They felt really good for me last year when I was basically getting income when everything else was going rubbish. But it's not my main driver. So I do also expect this dividend yield. It's not forward dividend yield. It's basically a lagging indicator. So the way that this is worked out is it's my current portfolio value divided by the previous 12 months. So right now that's divided by my dividend received in 2022, right? As we go through the year, I'll update that. So it'll be February to January, then March to Feb, and so on. But right now it's 2.2%, which is modest. You can see here as well, just to call out a couple of other things, my average per month is currently 230. Obviously, I'm expecting that to go up, and then this is sort of per week, per day, etc. I sort of borrowed some of this from Investing Sensei. I really like his videos. I think he's a really good channel and probably deserves a few more subscribers. And he has a target of getting to 20,000 subs this year. So definitely check him out. I suspect many of you won't be familiar with him, but I really like his channel and the way he does it. And so I've borrowed that from that perspective. So overall, we'll keep an eye on this. I'll sort of revisit them periodically. I mean, this table here, we're not going to revisit for at least another, we'll revisit it rarely just to see how we're doing. But this one, we'll basically revisit it maybe once a month when I update these figures and everything gets calculated. So, but this is kind of cool. We're now past 1/40th of our way to retirement. And, I'll expect this figure to go up and up over the next sort of 20 years. So that's the walkthrough of the dashboard. Quite a long walkthrough for the dashboard, but again, lots of changes and lots to talk about. I don't have any more substantial plans in terms of this dashboard, so I expect future updates through it to be a little bit more succinct and shorter, but otherwise that's how it looks currently. And now let's have a look at our companies that we're focusing on and specializing in. All right, so we continue to refine this presentation. Again, I'm still not super happy with it, but it's a work in progress. I was focusing more on the dashboard. First of all, I'm not going to display a line just to say no news. I'm just going to mention any ones that I excluded over here. I think that makes it a little bit less of an eye chart. So first of all, no news this week in terms of Hollywood Bowl or Polymetal. I'll change that as and when we get some news. So, and again, these are roughly ordered in terms of what I think is most important. The first of all, Games Workshop, I've just done this one line as a tease in the hope that you're going to stick with me for another 10 minutes. If you do, we're going to walk through that half-year update. I'm going to give you my thoughts and we'll go from there. Next up is Gamma Communications. So this is a top 3 holding for me, currently my second largest. The trading update that was shared was effectively that earnings were going to be in the top half of expectations on a range that was already increased. So positive from that perspective. I think the main call out here, and I know I'm not alone actually, a lot of other analysts also called out, was basically their cash generation was really impressive during the year. Their cash on hand currently stands at 92 million, which doesn't sound much until you realize that's about 9% of their market cap is in cash currently. Gamma themselves flagged the fact that they were really positive in terms of their revenue to cash generation. Basically, they're incredibly efficient as a business. Again, I've spoken about them before. They have incredible financial efficiency metrics. And the fact is, like with telecoms companies, the way to think about it is you have build revenue, but against that build revenue, you have discounts. So then you have like net, right? And discounts are things like, introductory periods, 50% off, etc., etc. So they're your discounts. That then gives you your build net figure. Beyond that, you then have credits. So that then gives you your kind of net position that you've built overall in terms of your net revenue, right? So that's goodwill, any technical failures, that kind of stuff, right? And then beyond that, you've basically got what's called dunning, so your payment and collections attempts. And what that basically means, you have multiple steps to get from like your headline, this is what we're selling our service for, right, down to what actually is in the bank. And Gamma I haven't seen details, I don't have access to the exact I call that a waterfall, but and I've introduced it when I've worked in other telcos. But for me, it's a really important metric for telcos to be on top of, because it kind of shows that, how you're doing as a business. Like, are you having to discount in order to get customers? Are you having to credit in order to boost your customer satisfaction scores, right? What does your collection look like? Do you have high debt? Does it take you a while to get money in, right? All of those things basically factor into this. And Gamma are rumored to have an incredibly efficient waterfall, and so they haven't published the numbers of exactly what that number is, but the fact is that they called out that they're very strong basically in turning their revenue into cash. And certainly, like, this business is now really starting to throw off cash, in my opinion. They only had a very small acquisition, a Spanish bolt-on during the year, so 92 million for them is a lot. And again, just to put that into context, the last dividend they paid across 2022 was 13 million, so a tiny amount compared to just how much cash they have available, and essentially no debt on this company either. The UK business is, I would say, humming. The company update that they did in November basically said that the European business is the UK business 8 years ago. I found that timeline interesting because that's when I was dealing with Gamma fairly regularly, and I have very strong and favorable opinions about Gamma, as do basically all of my colleagues that I talk to in the industry. Everyone loves Gamma. We think it's built an incredibly good and scaling solution, and I think it's starting to show that basically. So in terms of growing UCaaS, now just to explain this acronym, because it's definitely not standard even within the telecom industry, this is Unified Comms as a Service, or Unified Communication as a Service. Basically from SaaS, it's not an industry standard term. Like BT would class this as fixed mobile convergence, FMC. Then you had like unified comms as well, like UC, just as general. So I guess like lots of companies are trying to own the language. I suspect Gamma have picked this because they have an unbelievably high recurring revenue figure. So their UK recurring revenue figure is 92%. Their total recurring revenue figure is 89%. And that's only because where they've been buying European businesses that are a bit less mature, they still have a lot of things like usage as part of their revenue makeup. Whereas telcos, as they've gone through this journey, become closer and closer to like IT hosting. And so their business model and their financial model changes. Gamma is so much further along than, especially like major incumbents like BT. It still provides more SIP usage, for example, than BT does in the UK. So it's a very real player from that perspective that, in my opinion, is a decade ahead of many of its competitors and has built a solution that is at least good for the next 10 years. They've really thought ahead. The one exception was in Spain, where they sort of highlighted some challenging markets were making it difficult to scale, hence part of the justification on the £4 million bolt-on. The full results are scheduled for the 21st of March, but I would expect them to be broadly positive. Certainly the trading update was reasonably well received. Shares went up about 5%. I still think Gamma is an absolute steal. I have a very large position in Gamma, but yeah, I think it's a very good company that doesn't look cheap on paper if you're just crudely looking at, you know, PEs and stuff, but has all the foundations to be an incredibly successful business for many years. So I'm very excited about holding this basically to retirement. It's my biggest dividend growth company, I would say. Like if I think about Gamma, they are your textbook dividend growth company, 13 to 15% every year dividend growth. Obviously the share price at the moment has had a really torrid sort of 18 months. I think it's completely unjustified, but there we go. So we'll see how that shakes out, and I will do a full review on the 21st of March. Genius Sports here. I mean, I wouldn't normally put this high, but the fact is that the company had a really good week. The only real news I could find was a very positive review by Needham, like an investment bank. And their argument was that the shares should potentially double, which would be lovely for me because it would basically make me green. I think that is quite optimistic. I think right now the share price should be in the mid fives. For me, is where I think it should naturally belong. They highlighted though all the stuff that I would highlight as well in terms of, you know, the move to operational profit expected in a year. Lots of deals that are being signed up. You know, they're continuing to sort of go with the America as it's being legalized. And effectively, they have years left on a bunch of exclusivity relationships, which they've been very good at enforcing, right? They've won a couple of lawsuits and settlements that have meant that third-party providers have to buy their service, which they've got exclusive rights on. So it seems like they've basically defended their business model. It's been proven. And now it's a case of, you know, making sure that they continue to deliver, which they've been doing very consistently across 2022. So I think the price target here was really ambitious. Maybe it was more of like a headline grabber, so they wanted to put something that was particularly eye-catching. But yeah, I think there's a lot of promise in this company. It does have a little bit of unfortunate with SPAC legacy from sort of 2021 when everyone was a bit excited. But I think underneath it is a good business that seems professional and is scaling very nicely, basically, and has a management team that's doing what they say they're going to be doing, which again is pleasing from a small business perspective. In terms of Evraz, there was a good write-up from Armchair Trader. They gave a nice bit of history as well as explaining the difference between Evraz and Polymetal. So Evraz is no longer trading, basically, and the reason for that is because it has recognized oligarchs, most especially Roman Abramovich, as majority shareholders, whereas Poly doesn't have the same kind of clear issue. Likewise, as well, it's been argued, although Evraz has disputed this to be clear, that Evraz's steel is being used in tank production. Evraz maintains to this day that its steel does not get used in tank production, but that was part of the justification for sanctions against the individual oligarchs and Evraz in particular. The article itself, though, basically highlights that Evraz is potentially an investment for the incredibly brave and risky, points out that the business continues to do just fine, turned a modest profit last year. It also highlights that if it was forced to sell its North American operation, that it would expect cash for it. Again, I'm not entirely sure how that would work with sanctions, because presumably America wouldn't want US dollars being paid into Russia, especially if the argument is that there's a very close relationship between either the army and Evraz or, you know, Abramovich and Putin, etc. So again, I'm not entirely sure how that would work from an actual cash payment perspective. Not sure. But yeah, they were kind of quite optimistic in terms of the value of the North American business, which we've touched on beforehand as well, which is basically building railways in North America. So yeah, I think the write-up was interesting for anyone who's very new to Evraz and doesn't understand either the history of the company or the very recent history with the sanctions, etc. It was a good introduction. Obviously, at the moment, for any UK investors, you can't buy Evraz, but you can do if you have access to the Russian stock market. It still trades there. So yeah, obviously buyer beware if you're dealing with Russian stocks, and we go from there. In terms of medical properties trust, so I mean, in fairness, MPW continues to be really well covered. There's tons of articles about it, but on the whole, the articles aren't adding a ton of value, in my opinion. There's nothing really new here. The one thing I would say is that, I've learned that, or you can calculate basically, but the 7% market cap here. So these are commercial loans that they've made to tenants. Typically, MPW has two ways of doing commercial loans. The most common one is they basically charge 8% interest plus, as well as some other sort of provisions, or they take an equity stake. They do have equity stakes going up to 50% in one or two of the ventures. This is actually one of the bearish arguments against MPW, that it's far too incestuous with its customers. I don't really think it's a particularly strong bearish argument. I kind of, there's meant to be like some improperness raised from that, right? But again, it's not just MPW that does this. A lot of specialist REITs, including in the healthcare sector, do this as well. They've been doing this for the better part of a decade. It seems a relatively standard model to help hospitals with cash flow, especially over the last couple of years when a lot of the elective treatments didn't happen because of COVID. And yeah, to me, it's not a huge issue as long as they continue to run that like a proper commercial consideration. And I would point out as well that there's a $200 million repayment due this quarter from one of these commercial loans. So again, as long as we continue going through that and it works, I don't really have a concern with it. It's not like with Realty, and a single customer who Realty don't have a ton of knowledge about that customer, is so generalized and spread, it doesn't really make sense to, it's just a different business model to compare it to, good REITs. So yeah, I think, again, a lot of the bearish arguments aren't there. I'd also point out here that 99% of rents were collected in Q4, but there's a couple of caveats here, which is the purpose of that star. First of all, you have to make adjustments for three reasons. So I'll start with the one which isn't MPW's fault at all, which is that about 1% of their revenue needs to be spread across 9 quarters because of some state legislature in terms of how income is spread out. So fine. Then you've got the situation where one of the hospitals asked for a rent break. MPW agreed 4 months rent break to be spread out over 2023 on a commercial basis, so with interest basically, which again, I don't really consider that a particular problem. It's one hospital in 4 months, so I think that's absolutely fine. The last one is with Steward, where there is a strong relationship. You've got like sort of key personnel in both organizations who have been involved with each other for many years. And, basically MPW does aid them with their cash flow. It also doesn't help because Steward is a private company that has no legal obligation to publish 10Ks or any other thing like that. The thing is, though, that they did, Steward specifically now, who account for 26% of MPW's income. They did recently announce a rolling credit facility extension with their lenders, which to me, presumably the lenders would have wanted to see the financials, right? And the fact is that they were willing to lend them, more money, to me indicated that the financials can't be truly bad, right? Otherwise, banks are going to be cutting their losses, etc. And again, I just underwrite that by saying that even if Steward did go to the wall, MPW have had to go through sales before where people went into Chapter 11 and then bankruptcy, and they just resold the hospitals and or reletted them and basically turned a profit. So I don't really consider it an existential problem. And if anything, if Steward did hit the wall, I would consider it an absolute buying opportunity because the shares would absolutely tanker, even though I think that the whole business model is fundamentally unchanged. So we'll see. So yeah, lots of news is being written about MPW, but so far I don't really consider it any change in existing understanding. I want to call out Phoenix here. A couple of nice things. So first of all, they have a Vision for Literacy pledge, which so far sees them involved with 3 schools near its office. This new school, I think, is the largest. It's a 1,000 pupil school. And basically what Phoenix do is they go in, they send their staff in, and they sit with disadvantaged students to teach them sort of literacy, both traditional and financial literacy. For me, I went to growing up on an estate and then kind of not having particularly good exposure to financial literacy. I think it would be transformative to many people. So I'm a big fan of this scheme. In fact, it doesn't have any sort of gender or race attachments. Basically, if you're a disadvantaged school, they go in, they talk to you, etc. I'd also point out as well, nothing to do with Phoenix, but when I was working for BT also had a very similar program. Only the students used to come into BT's office, which at the time was in where was it? Chancery Lane and St Paul's. That's it. It was in St Paul's in London, and the kids used to come in, and they're like 15, 16-year-olds from disadvantaged schools. And you'd basically talk to them, help think about the future, etc., etc. And it was just kind of asking questions that maybe they hadn't considered beforehand. So I thought that was a nice thing. I'm a big fan of these kind of initiatives. Speaking of, as somebody who's been quite negative about ESG, specifically just as kind of a tick box exercise, I think it is worth highlighting also that Phoenix here won an award. It's a new award spun out of Climate Change 26. Called Terra Carta. I hadn't heard of this award before. What I liked about the award and its focus was on sort of sustainable revenue, sustainable investment, etc., etc. So it was still kind of accepting that there was a desire for capitalist growth ultimately, but it was sort of framing that in a way that it's like, well, you can still be a successful business and not wreck the environment, right? Especially if you're something like an insurance company, right? And obviously, if you're like an oil major, that's a harder conversation to make. But still, with something like an insurance company, right, there's no reason why I wouldn't expect a mature insurance company to really start thinking about this stuff. So Phoenix themselves are aiming for carbon neutral by the end of 2025. It's interesting, Gamma also have the same aspiration. And for me, it's not something that's going to factor in my investment decision personally, but it's worth mentioning that a lot of sort of financing is only available if you jump through enough ESG boxes. And again, likewise, why wouldn't you start to think about something if it's easy and doesn't cost you anything, or can be seen as a net good? So just to highlight that as well. So a couple of softer, nice bits of news, I suppose, for Phoenix this week. Next up, we got Kronos. I almost didn't include this because it seemed like a non-issue, really. We had one investment bank reducing their price target to 13.50 and also putting them on a sell from neutral to underperform technically. So yeah, Bank of America came out with a very bearish price target here. I wasn't able to get any details. I even joined several sites to try and get access to the details as to why BOA had reached this decision, but I couldn't, unfortunately. So sorry about that. I do try my best to kind of be informed on these things. But yeah, to me, Kronos reacted really badly to this. It went down 13% in one day. I would say Kronos was starting to approach fair value. It was maybe 5 to 10% down on what I would consider a fair value. But I would never consider it expensive. I think Kronos has held up reasonably well. Although again, even then it's down 30% from its highs before this, which for a tech is kind of good across 2022. But yeah, for me, I think Kronos, the last results were really stellar. I think it's a very nice proxy play on Workday, the listed American company. This is a fully profitable company. The main relationship with Workday that Workday have in Europe as well, and a really strong business. I don't really understand this downgrade at all. It wasn't even like they had a ridiculous target before, so I don't really know what else to say other than that, other than to say I strongly disagree with it. Basically, my price target here is sort of close to the 1800s at the moment, and I'm very happy owning Kronos. I still am up comfortably, sort of about 15%, but I had been running 30% green. So we will continue to hold Kronos without any issue, and I don't really have much else to add beyond that. Amcor, which is now quite comfortably our largest holding, it popped up in a Seeking Alpha article covering 10 semis to buy for 2023. The article itself, for me, gave a good overview of a bunch of semis that you may or may not have heard of. Obviously, I don't think the article itself is going to make anyone go out and rush to buy because, it's introductory on all of them. For me specifically, I think it was nice to see Amcor mentioned in this. It's also super high in terms of how it ranks it in terms of the sector opportunities. It pointed out stellar earnings in its last quarterly update, which again, I would completely agree. I think the earnings are incredible, especially considering some of the peers. And the only nervousness I have is whether the next quarter will still hold up just as well. But I think Amcor are really delivering and executing on exactly the reasons I have them. So basically Class A grades across most of the sector in terms of the metrics used. The only thing that got a D was in the dividend, and again, it doesn't pay a huge dividend. It has a tiny payout ratio, and a relatively small yield as well, but it's just not really the main focus. Saying that, they did increase their dividend by 50%, but it's still a very small dividend even after that big increase. But again, if Gamma is very much my dividend growth company, Amcor is a close second. Like, I think I first got into Amcor because there was tons of upside as well in terms of the growth, but I could also claim that Amcor is a good example of a dividend growth. I expect this to become a very nice yield on cost in the future. Huntsman as well. I'm really looking forward to the results in February for Huntsman because it's going to be an interesting thing. Lots of changes across Huntsman across several years now that kind of starting to crystallize. This article basically highlighted what they classed as improving macro trends, specifically in Europe. Huntsman's very negative on Europe. The chairman especially, so the founder, is extremely negative about Europe. He sees it as backward looking, behind the curve, not offering a particularly nice business environment. He's incredibly opinionated on earnings calls. I kind of enjoy them for the frankness. But yeah, so they're considering their future in Europe effectively, even in the UK where they're relatively big, and they have some very heavy intense energy requirements in their UK operations, and where the gas is slightly cheaper, even there he sort of says, it's not particularly great from a profit margin perspective. So it'll be interesting to see how Huntsman sort of view this changing political and economic situation developing in Europe. The article basically argued that it looks fairly cheap and offers a high yield, have similar price targets to myself, so potentially a 20% upside. And yeah, it was just based, I would say it was a fairly positive article. They weren't claiming for a moment that Huntsman was the best company you've ever seen, but Huntsman's been on this interesting journey over several years and has, in my opinion, a cool exposure to EVs and that sort of stuff in many ways. It does a lot of kind of the ingredients and the technology required to make green infrastructure run more efficiently, which I think is cool. So a lot of chemistry involved to get your head around here, but ultimately it looks to me as well like a reasonable entry point even at $30. H-band, not a ton of news here, just another analyst moderate upgrade in the $16 to $19 range, so that seems to be where everyone is settling, myself included. By the way, I'm at $17.20, so we'll see again when their updates come. And Fevertree should also be interesting as well. They have a trading update due in 2 weeks. This is crazy split in terms of expectations from analysts. Like, some analysts are really opinionated on the downside, others on the upside. It has a very wide analyst estimate at the moment. For me, I would like to see revenue of about 360 and profit of about 40. I would expect if they hit those numbers, the share price would remain above £10. We will see though, basically. I think a lot of this is going to be a combination of how inflation costs around things like staffing get offset against things like falls in freight, and also the fact that they've nearshored production in America now, so they don't have the freight costs, and the wider logistics as well. So I'm kind of expecting to see positive movement in the US, and then I'm really not sure what to expect kind of in the UK, Europe, and globally, which tends to be Australia led. So that would be really interesting to see. I know that Fevertree positions its product as super premium in America, so likewise that would be interesting to see how that looks from a branding perspective. So yeah, lots of uncertainty for me actually in Fevertree. I do think Fevertree again has a lot of potential, and it just needs to manage its costs and stabilize a little bit. Share price has recovered from very low when it sort of halved. It's recovered about a quarter of that. So still kind of relatively modest. I'm still comfortably red on Fevertree, luckily not a particularly big position, and we will see what the earnings hold basically. I also want to touch on just general macroeconomic news. This is something I do want to start covering in a bit more detail in the future. So first of all, UK GDP growth of 0.1% in November shocked a lot of people, myself included. The market expectations were minus 0.3%. I was expecting sort of minus 0.1 to maybe flat at best, but definitely not expecting a positive figure here. This is kind of quite important because Q3 in the UK was negative. So if Q4 is negative as well, then it means that we're officially in a recession, right? But because October was a pretty decent month because we were kind of catching up after the Queen's funeral, where we had an extra day off, etc. So you kind of ended up in this situation where a lot of the bad news got put into Q3. And then Q4 now is kind of looking not exactly stellar, because even with October and November, you're still only looking at about 0.5%. But actually, as long as December isn't an absolute disaster, it basically needs to be 0.6% in order for the UK to have entered into a technical recession. It obviously still doesn't feel especially great to sort of be treading water, but 0.5%, 0.6% in a quarter is pretty standard for sort of a mature economy. Plus 2% growth year on year is respectable. So now I think that's overdoing it for sure, to be perfectly clear, but it does kind of show to me that it isn't the disaster that again has been portrayed for 2023 and the wider economic situation. Just to extend that as well, Germany had relatively reassuring numbers as well, which is kind of the engine of the European Union. France, because it doesn't have, it has a lot of nuclear power, so it's not as exposed as places like Germany to fossil fuel prices, mainly gas, has kind of done better actually than the UK and Germany over the last year or two. So, all this kind of means that there's a pleasing environment starting to develop in sort of the more developed economies within Europe. And likewise as well, there were no surprises from the US data on Thursday. So there was a lot of concern about what inflation would look like, what jobs would look like, but all of it was kind of pleasingly boring. I think it was about as good as it could have been, because I think people would have read into things if it had gone down too fast, right? There would have been concern about tightening too quickly, raising interest rates too quickly, that kind of stuff. And again, if it hadn't gone down enough, then there'd be concern about slowness and still inflation and all of that kind of stuff. So it was a pretty Goldilocks zone kind of a couple of data sets that came out on Thursday. And likewise, more globally, a lot of the stuff was relatively positive. Again, that's probably pushing it in terms of, a baseline, but compared to what people were expecting, it's a lot more positive. And, that kind of coupled with China threatening to reopen following their lockdowns is giving people a lot of optimism. And that I think is really what's been underpinning the last couple of weeks in terms of share price performance. It's, the FTSE 100 especially is very close to all-time highs. The S&P had a lovely recovery as well. And I think, there's a lot of optimism that 2023 won't be quite as bad as people expected, and therefore there's a kind of reassessment of what the share prices should be for companies, right? So again, for me, I have less of a readjustment because I was on the more optimistic end anyway, but certainly one or two of these did surprise me, just because I thought that the UK GDP growth would be worse. I think it surprised basically everybody that there is more of a recovery there than maybe people were expecting. So just wanted to touch on that as well. And that's my updates for now. But before we go, let's have a look into Games Workshop results. All right, so let's have a look into Games Workshop's results. First of all, I would say that they were not well received. The graph there on the right shows the 6% reduction as soon as the results were published. Now, I looked at them a couple of hours after the results were published, and I was writing in Discord at the time, and I had like an initial review, and it didn't look that bad. And then a few hours later, sort of late afternoon, I had a bit more time to look into them. And to be honest, I felt like they were pretty much what I was expecting. And I felt like if you were familiar with the business and, you got on top of the results really quickly, there was actually a really lovely buying opportunity there. I feel like the market is still coming to terms with exactly who Games Workshop are as a company. And so they saw the numbers and they were disappointing without really understanding Games Workshop's business as well as I think I do, which I don't mean that to sound like arrogant, but I just feel like I have a better understanding than apparently many of the people who had bought shares in Games Workshop, who I guess are like institutions and along those lines as well. Certainly for me, again, this is I think the third or fourth look at financials I've had now with Games Workshop. It was basically what I was expecting. Diving into that, I will accept it was a bit of a mixed bag. I think the main reason for the mixed bag is basically the way that the revenue is split. So Games Workshop split their results into two main components, what they call core revenue and then licensing revenue, which I think is fairly self-explanatory. Just in case there's any doubt, core revenue is basically the production of the paint, the models, the codexes, which are basically the rule books, the stories, the lore more generally, right? Everything that isn't IP effectively. And then the licensing is everything that is IP, which primarily at the moment is games, but it can be one or two other things as well. To me, it was a reflection of the change in the revenue that caused the profits to basically be to fall by sort of 5 million. If we look at it from my perspective, I would say that although the profit was down 4.6 million, licensing was down 5.8. So again, the way that the margins work with licensing is it's almost entirely profit. Like if you look at the revenue reduction in licensing, it's 100,000 out in terms of the profit because it's almost pure profit. So they both fell sort of 5.8 million, and then the profit was 5.9 million. So it's sort of like pure profit. So effectively, because licensing was reduced so much, then that's what's causing much of the reduction in overall profits. That said, there was a notable reduction in terms of its gross margin by 4.3%. However, I'd caveat that by pointing out that it remains at 64% even after that fall. And likewise, core, so specifically now excluding IP, core return on capital employed slipped to a mere 112% from 118%. So I mean, effectively, for every pound that they invest, they double and a little bit extra, right? So again, like, this company is still fantastically good at the profitability, right? Again, a lot of people, I think, are overlooking that because it has not been the easiest 1 to 2 years for Games Workshop, but it still is a fabulously profitable company that continues to throw off cash. This was a company that had an extra special dividend in last quarter. So if you were a holder across toward the end of last year, you got 2 dividends in a quarter, and now their dividend yield is really starting to be noticeable. Like, I'm expecting this year for it to be sort of between 4 and 5% unless the share price moves materially. So from that perspective, I felt like the numbers were okay. Actually, to be honest, I said last week I was expecting somewhere between sort of 5 and 10% revenue growth. Core revenue was actually up 11%, so better than I was expecting, and certainly better than the market was expecting. But I would caveat that of that 11%, 7% of it was due to favorable FX movements. So you could make the claim that actually their revenue was only up on a 4% like-for-like basis. I think that's a reasonable position to take, but you also have to remember the fact that their costs would have increased as well as a result of that as well, right? So the kind of weakness of the pound is good from an earnings perspective, but is bad from a provisioning and purchasing perspective as well. So for me, I guess, like, I'd sort of be keen on sort of averaging those two out, getting to sort of a 7 to 8% revenue increase in kind of like a true number. Certainly once you get, of course, into the earnings from a cost perspective, and sort of leave it there. To me as well, like, they do actually have a lot of interesting IP coming through at the moment, but the way that the reporting standards work basically means that they take all of it up front. So a lot of the IP win was in last year, which has again like caused very tough comparables, even though there is a lot of stuff coming out at the moment. And again, those games are pretty decent. Like their mobile game, Tacticus won Mobile Game of the Year, and the rest of them, like Dark Tide, Necromunda, there's a few others as well that have been well received as far as I can tell. And likewise this year I'm expecting Space Marine 2 to be a real hit. So we'll see how that looks, and that's before we get into the details with Amazon and that stuff as well, right? For me, I think it's worth highlighting a couple of weaknesses that were brought out by the report. So first of all, they highlighted North America, which was flat against last year records. So North America is very, very much seen as a growth area to them, and they did have a very good, strong last year. For me, it was a bit concerning to actually read between the lines here a little bit, because their viewpoint is that they're having to skill up the senior management team in North America, and also that they weren't particularly aligned from a global perspective in terms of knowing what that scale would look like. So again, if I go back sort of 6 and 12 months into these reports, they were highlighting that the logistics meant that they couldn't maximize their sales and things like 5 million lost here was the number for North America. And to me, it kind of signals a company that isn't quite operating efficiently yet at the scale that they find themselves in. There was 1 or 2 other things as well that they mentioned about the fact like they're not used to operating at this scale, and it's like, yeah, I get that, right? Like this is new to you. I totally get that. You're new to international expansion. This is kind of a new phase in your company's existence. But I feel like that's where you start planning a year or 2 ahead as a management team, start finding the right people to help with that, right? You find somebody from Hasbro or Mattel or somebody who's kind of used to that sort of thing, right? Yeah, I think for me, I was a bit disappointed in that. I guess it's good that they've recognized that, but it still feels like they're a bit of like a year behind. Likewise as well, I went back and watched 1 or 2 of my previous videos, because last year I was reviewing a similar report, and I said, reading between the lines, I can tell you that they're having IT problems, right? And this time they've called it out. And to me, again, like, if I can call that out from the words that are being used, they must be quite significant. A CEO doesn't say stuff that you can read between the lines on unless it starts to become an issue. So to me, I was really disappointed. This was one of the things that actually I was like, annoyed about, that having noticed this a year ago, which means if it's got to the CEO, it's already 6 months behind where it should be, right? So having noted it a year ago, apparently IT is now costing us more time and money. Like, what have you been doing for the last year? Weren't you hiring people specifically to address this, right? And I think a lot of people forget as well, but like Games Workshop from about 7 years ago had like a meteoric rise, and part of that was seen in an upgrade of their CRM system. So for me, it feels a bit disingenuous to talk about legacy systems. They're not that old. Like, what did you do in the past in order to kind of help you facilitate this ordering journey, making sure your shops were well stocked, right? Like, what's gone really wrong here? And again, reading between the lines this time, it feels like there's an integration problem basically. So I'm assuming it's maybe like an ERP system or some kind of inventory management system. Like there's some kind of system that connects with CRM that isn't working, right? I'm just calling it now. Again, I've read enough of these and work in project changes and stuff like that. That to me is where the problem is. And again, the fact that they've been aware of this at senior level for at least a year is concerning. I think it's like, I don't want to be in this position in a year's time as an investor when actually the North America stuff is still a problem. Like, get on top of it, guys. So again, I feel like Games Workshop, they're not a million miles away from the FTSE 100. Like, this kind of amateurish to me isn't really acceptable. And again, I always kind of compare I was on the management team for a business that was worth $1/3 billion. So I kind of have certain expectations of what I expect kind of penny stocks to 3 billion to look like, right? And to me, if I was on a management team and had an IT problem that wasn't fixed for a year, like somebody would be getting significantly reprimanded, right, by the CEO. There's no way that my CEO at the time would have let that kind of stuff slip for a year. So it's just, I just feel like there's a lack of skills operating at the scale that they've now found themselves at. And just like with Fever Tree, I was calling out for, you know, like a money man who'd worked with previous drinks companies, and then they went and got that guy from SAB Miller and gave him a promotion fundamentally. So here I feel like they need to get somebody who is a logistics or a kind of CCO type person who has experience with something like Hasbro, like a big gaming company or a big hobby company, who really kind of is used to that multinational operational scale, and get him in quickly, right? I think Roundtree on the whole, the CEO, is decent, clearly. He's delivered great shareholder return, but I feel like there's a missing skill set there that they need to buy, basically. I'm not sure if it's a management consultancy that they need. I'd rather see something a bit more long-term and get them sort of scaling for the next kind of 5 years on that journey. So that was frustrating for me. On a more positive note, the production upgrades were positive. They fully expanded their painting factory in Nottingham, so they do all their own painting. That's considered, they don't call it out specifically in their core revenue. I'd love to get details into that level, but I suspect that their paints are quite significant in terms of revenue. Likewise as well, they have 2 other factories, so they've got 3 factories all in Nottingham. The 2 other factories do molds, so they basically produce the 3D models, and that saw a 15% increase in production over the last year, basically additional molding machines. My understanding is also from a previous report that they've upgraded some of their older stuff, so actually the number of machines is up 15%, but I think their production is slightly north of 20% as they bought 1 or 2 of the machines more modernized, basically. So that's good that went without any hiccups as far as I can tell. There were some logistic difficulties in 1 or 2 of their warehouses last year, but there's nothing mentioning in the report that's negative on logistics. I'm assuming now their warehouses are all up and running, etc., etc. There was no update on the Amazon tie-up. That was expected to me. I'm not really expecting anything until at least another 6 months. The character there that I've put at the top, that is Inquisitor Eisenhorn. That would be my personal preferred option in terms of a streaming series. I think it makes sense to either do somebody like Eisenhorn, or a lot of people are suggesting Commissar Kane. With these characters, they're kind of morally ambiguous. They work in parts of the Imperium, so humanity's empire, that basically allow them to kind of operate and introduce a wider setting, right? Like if you're going with sort of Space Marines, that's first of all, it's very war focused and will be very expensive. With the Inquisition, they get involved in all kinds of stuff, right? So you do have the wars and that they get involved into, but it's a bit more of like the politics. So I'd kind of be hoping for something like a bit like The Expanse that kind of touches on both, right? Has that high drama and some war. It's not huge a part of it, but there's definitely conflict, as well as some battles. and I'd like to see something along those lines. There are things that I'm not expecting it to be, which are sort of storylines that Games Workshop themselves are already working on, because Amazon benefits from the IP sales, right, and the merchandising. That means there's no way they're going to be given storylines around like the Ultramarines and Gilliman, right? He's like the one surviving Primarch who seemingly is out and about. So there's no way it's going to be touching on Roberta Gilliman and the Ultramarines. It'll be something different. It could be on things like the Lost Primarchs, because there's no lore on them at all. So you could do it along those lines, and kind of that would be interesting. But the thing with that is it's basically a dead end from a lore perspective, right? They're not in the modern setting, so where do we go? Whereas something like Eisenhorn gives you that, or Kane, I totally get that as a rationale as well. And to me, I think it makes sense to do something where you can look at you can look at things like the dreadful bureaucracy in the empire, right? And then you've got like things like cults and heretics, and you've got kind of political intrigue. There's a lot of kind of internal politics that you could do relatively cheaply but still make really gripping and interesting, as well as this stuff happening in a wider context. So I've picked Inquisitor Gregor Eisenhorn there. I think he's a cool character. He kind of flirts with the heretical side, and the Inquisition are kind of a basket case in many ways. So I think you could have some real fun with some of the more face-palming moments of some of that lore. We'll see. But yeah, so I'm very excited. I don't expect an announcement within the next 6 months, honestly. I think it's important they take the time to get it right. And I think it's important that they consider a faction that allows them to explore and basically broaden the universe very gradually, because it is absolutely ginormous. Millions of planets, literally, like the Empire of Man has millions of planets. And okay, they're arguably the superpower, but not by a ton. And there's all kinds of other things in there as well in terms of races and factions and histories, and it's just going to be a mess if you try to dive in too quickly. So yeah, I think I favour that approach, but we will see. I think the other thing worth finishing off is, although they see themselves as kind of growing their dividend, they've always spoken about truly surplus capital. In the last earnings result, they actually updated what that meant, and to me, actually, it was quite light in terms of the. There's a lot of truly surplus capital. They talk about having enough to like pay bills for 6 months and working capital for 3 months, right? It's like, well, that's not, you don't need a ton of money for that. So it was interesting. I actually have spoken before about the idea of buybacks. I think there is an opportunity for Games Workshop to do buybacks. I would personally like to see sort of the dividend maybe trimmed to sort of 50 to 75% of what it is now, with the remainder going into buybacks. I get why you don't want acquisitions. I think that's perfectly sensible. I can't think of a ton of acquisitions that would make sense, if any. It might be like a paint manufacturer or something. Why would you need to buy lore? You've got a self-contained universe, or a couple of them actually. So that doesn't make any sense. But to me, buybacks do make sense. So I wouldn't mind that as an idea. However, I'm more than happy to receive dividends. And again, I think this is actually a notable dividend yielder, all things considered. So for me, it didn't really make me, these results, because they were in line with my expectations on the whole, other than this kind of pain around the IT stuff and the North American stuff. Broadly, the numbers themselves are about where I would expect them to be. All of the recent hype with the share prices around the Amazon type, which makes sense because, again, the IP side of the business, depending on the details of those commercials, that's where they make all the money, right? So again, there is an opportunity here for Games Workshop to make significant profit when that commercial model is finalized, when the themes are worked out and everything else. Until then, it's all kind of just hope. And obviously, because of the power dynamics here, I'm expecting Amazon to be quite demanding. But still, I'm looking forward to it, especially because Cavill's involved, and I'm hoping Amazon will give a significant creative license from that perspective, having been slightly burnt with one or two of their other sort of heavily fandom series, shall we say. So my price target remains 120. Again, the price target at the moment is a little over 90. I also have a aim for this year, like one of my predictions for this year, is for Games Workshop to pass £100. A lot of that will very much depend on the Amazon deal, unless, again, that drags on and then the next 6 months are good. In terms of what I'm expecting over the next 6 months, I'm basically expecting further revenue growth around the sort of 10% plus. I'd actually like to see that slightly accelerate into the low teens. So something like 12, 13, 14% would be great. I'm also expecting a slight improvement in core operational profit, because that's something that, again, as things like warehouses are improved, freight costs have reduced, input costs in terms of the hydrocarbons for their molding and their paints, they've reduced. So I'm expecting a lot of reduction in those costs. Yeah, there are some cost increases for staff. They do pay their staff well. I think it's a nice thing that they do with lots of bonuses and stuff like that. So that's cool. I have no problem with that. I think it's nice. But I am sort of expecting some cost controls to be brought in. I am expecting them to fix their IT problems, to improve their management team, and to basically continue to look for IP opportunities, although I think a lot of those will be on hold until we work out what Amazon is. I'm sure that's where all the focus is at the moment. So that's going to be kind of a boom and bust. It won't be incremental. It'll either be amazing and the market will love it, or it'll be disappointing and the market will hate it. We'll talk about that if there is something seismic that happens, but I think it will be one or the other. What I would say is actually, though, since sort of Games Workshop went from that sort of £60 and then it jumped up to 80, it's gradually been eking up since. So there's clearly some excitement that's there. The results then were published and certainly initially caused a heavy reaction to the downside, which was then processed, and I think kind of the sensible decision and outcome happened within a few days. So again, I wish that was a point where I was still buying individual shares, where I sort of felt the confidence to go against the market. I wonder if I would have done or not. Who knows? But congratulations if anyone did buy that as an opportunity, because it was definitely there for a few days for you to take advantage of. Otherwise, though, we continue to do more of the same. Company goes ex-dividend, I think, on the 19th of January, so there's a chance to qualify for the upcoming dividend. Obviously, that's your decision, and we'll expect the share price to react to that as well. I haven't got anything else to add on Games Workshop, or indeed anything else. A super long video. Thank you all very much for watching. I've been the Boss Hog, and good luck with your investing. Bye for now.